It's been a tough few years for real estate, following back-to-back speed bumps, demonetization, new realty law and GST. Some signs of turnaround emerging though, at least in the commercial space, some signs of recovery, and private equity investors pumping money into the space as well. So what is it that companies or lenders to these real estate companies look forward to right now? How is the confidence there? Let's get in Amit Bhagat. He's CEO and MD of ASK Property Investment Advisors, joins us right now on the show. Amit, good having you. Thanks much for joining in. The idea of this conversation stemmed about after this news piece about ASK lending some money to Tridhatu developers came out. And we thought, why not talk about what is the confidence within the lending system when they go out and allocate capital to real estate developers. How is the scenario looking? Is it very, very selective right now? Is it geography specific? Is it project specific? How is it looking right now? And is it any different from what it has always been?
So let me clarify. We are a private equity investor and not a lender.
Sure. Okay. And from an investor's perspective, let's put it that way.
Yeah, so from an investor perspective, let me divide into lenders and private equity, because private equity players will always be opportunistic. They will look at project-specific, very selective investments where they can make money. Because there is no certainty of making money. If the project makes money, the private equity investor makes money. Whereas lenders want guaranteed returns. So after the liquidity crisis in September end, lenders have taken a backseat because lenders are very, very selective in lending, and also there is not enough money available for refinancing of the projects. Whereas private equity investors, when there's a dearth of money, the opportunities become too many for private equity investors. So private equity investors have a wonderful opportunity today for recapitalizing of the projects, recapitalizing of the companies. And that opportunity is coming with better margin of safety when liquidity is scarce in this particular sector. Having said that, to answer your question on the selectivity, yes, whether it is lenders or private equity investors, both are very, very selective. In fact, lenders almost did not lend any money in Q3 of the financial years 18-19, which is October to December. But I have seen lenders taking initiative of lending very selectively to very reputed developers because of the consolidation which is taking place in the industry, because of all the transformational changes which you have highlighted, which is whether it is regulation or GST, or the market has also moved from a seller's market to a buyer's market now.
No, but
buyers want value for. Sorry.
No, I'm saying that the lenders not lending in the October to December quarter could well have been a factor of the IL&FS aftermath as well, right? NBFCs didn't have money to lend in the first place.
Exactly. That was exactly the reason. But now they have started lending, but very selectively. When there is a scarcity of money from the lender's side, yes, private equity definitely has better opportunities because they can pick and choose. And pick and choose projects which have a better margin of safety.
Okay. We were having a conversation with Anarok the other day, and they were of the opinion that the large PE deals that are happening or have happened over the last few quarters as well have happened more in the commercial space. The IRRs are better, the security is better because the places are occupied, and the residential space has not quite seen that. Is your experience different?
No, we predominantly are focused only on residential development space.
Okay, interesting.
Whereas you are right, and Anurag is also right in saying that most of the deals which are big ticket deals have only taken place in the commercial real estate space. If you examine the space, commercial real estate buyers or investors in those projects are sovereign funds and very large institutional investors. They want stabilized assets. They are not willing to take a development risk. Hence, majority of the investment has flown into the commercial stabilized income yielding assets which are less risky.
Okay. So tell us how is the residential space looking like? The reason I ask this to you, because when you speak to the listed space, they are all largely the larger, well-capitalized developers whose projects are running smooth, sales are largely okay, and therefore the picture doesn't appear to be as bad. What about the tier 2 developers, for example? Have sales picked up, and what's about the prices as well? Because the channel checks seem to suggest that even if sales are picking up, prices have only contracted. What's been your assessment?
I think you have pointed the right challenge which the industry is facing currently. During this period of consolidation, when all these changes of regulation, GST, everything has taken place, then there was a uncertainty regarding the GST rates, which has now been crystallized. We have seen that the stronger players are becoming stronger and weaker players have a problem, because most of the players in the mid tier 2 and tier 3 category are over leveraged. They have not focused rightly. Most of them have not rightly focused on product and customer. When the market has turned from a seller's market to the buyer's market in the last 5 to 7 years, the customer wants value for money. There is no urgency to buy. There is no fear of losing out. They want affordability, they want quality, they want certainty. And hence they are willing to go to the reputed developers. And hence if you look at and examine the published audited results of the reputed developers who are listed, you will see that they have shown increase in the sales volume and value both. Whereas weaker players are not able to manage the expectation of the customer, and hence they are being forced by some of the lenders to go and surrender and give their projects to the stronger players or do a tie-up with them. And hence the problem lies with the tier 2 and tier 3 category of developers who are not well capitalized or who have over leveraged or over committed themselves without focusing on product and customer.
So Amit, what do you think is the way ahead now? I mean, for somebody who's looking at real estate as a space, do you reckon that the large, well-capitalized developers would only consolidate and strengthen their market, not market share really, but their revenues, stroke sales, and quite considerably over the next few years? Is that is that something that could possibly happen?
During consolidation, when the industry matures, this is bound to happen. You look at any industry. Initially, there will be a very large number of players, and then the number of players reduce. Having said that, let us also see that this is a very local subject also. Hence, the consolidation cannot be like telecom, where 3 players will be left, but every city needs 10 to 20 good players. And when I'm referring to cities, I'm talking about top 6 cities of the country. And hence, you will see that there will be consolidation, but there is enough room for everyone to grow, provided we set our house in order in terms of leverage, focus on cost, optimization of cost, delivery, commitment to the customer should be met. And hence, when the customer has the confidence that there is no uncertainty in completion, he will start buying. But he also wants affordable products. If you focus too much on luxury, then obviously the sales will always remain a challenge. And hence the consolidation in a maturing industry is bound to happen, and large players will definitely benefit because their cost of fund is low, their brand is superior, they get a premium for the product which they sell to the end customer. There is no uncertainty, and there is a guarantee of quality also.
Okay, Amit, before we wrap up this conversation, just one word on prices. Do they stay stagnant or lower, or do you reckon that there is a remote chance of prices moving up over the next 12 to 18 months?
With the input tax credit withdrawn in GST, some of the reputed developers will have to think, because their cost is going to go up and their margins will further shrink, and hence they will have to see whether they want to increase the prices to ensure that their Ebitda is maintained at the cost of the volumes. And hence, we will have to wait and see, because supply is not a limiting factor in the industry currently. Supply has increased and it is further increasing. With the regulation in place, there are compulsions to complete on time also. And hence, the market will remain stagnant for a couple of quarters, and it will be very project specific. If I'm able to sell a project very well, I have the liberty of increasing the prices. But if I'm not able to sell it, I will have to be content with this stagnant prices or reduction in prices, because cash flow is very important at this point of time. So it will not be a one shoe fits all. It will be project specific, developer specific, and the based on the absorption and the supply actually.
Great insights. Amit, thanks so much for providing these, and thanks so much for joining in today and giving us your perspective. Really appreciate your time.